Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas president and head of portfolio strategy, Nicholas Bohnsack. Nick, how are you doing this morning?
I'm well, my friend. How are you, buddy?
Doing good, doing great. I'm glad we get to talk. There's obviously still a ton of attention being paid to kind of the post-election fallout, cabinet positions, on and on. So I want to get your take there, but also, what are you all focused on in this kind of post-election couple of weeks here as we're starting to look towards 2025?
Yeah, well, listen, the election, the post-election politics continues to take a lot of oxygen out of the room. I'd say most of the attention is being paid to who the president-elect is picking to staff out his administration. I'd say in very quick succession, his first week was pretty straightforward when you think about the diplomatic team. The second and third weeks have become a little bit of a scrum as it relates to the economic team. And I guess the only comment we would really have on that ultimately is that corporations will wait and watch to see who's going to staff the economic team, particularly as it relates to tariff policy. But to your question, we're going to remain focused on sort of the building blocks of risk asset prices, namely earnings and interest rates. And on, I guess, to that end, earnings remain okay. Third quarter came in, stronger than it had been expected. When we look at July, when the quarter started, we're going to finish up about 8.5% on the blended earnings growth rate. And then if you even were to strip out the energy sector, you'd be up into the double digits, closer to 11.5%. So earnings look pretty good, and you didn't see quite a high degree of downward revision as we look through fourth quarter and into 2025. So systems go on the earning front. Interest rates has been a little bit more of a question mark. Of course, the Fed has, as you and I have discussed, sort of launched into a cutting cycle, but we continue to see the long end back up. And over the last number of years, when you've gotten towards that 450, 460 handle on the 10-year, it has not always been a recipe for smooth sailing in the equity market. So we're going to watch that very, very closely. And I think it has a lot to do with, frankly, inflation. And when you add in all that uncertainty, it certainly paves the way, or I should say, opens the way for a little bit more granular portfolio construction, which we like as portfolio managers.
Yeah, and so sticking with that, I mean, thinking about where you all are seeing opportunity in kind of an asset allocation sense, whether it's small versus large, international versus US, something else, where are you starting to see opportunity crystallize as we head into a new year?
Well, our preference remains on domestic shares. I think the Trump tariff 2.0 policy, and then, as we mentioned a moment ago, the uncertainty about who is going to staff that out, and in the policy as people principle, I think is going to put a little bit of a headwind into international shares, and not the least of which is that a lot of the global developed markets, Europe in particular, are struggling economically. So that needs to play itself out before I think we get a lot of confidence in the international on the international side of equities, particularly among the developed markets. When you look domestically, our preference remains large cap, but what's very interesting is we've started to see a true broadening away from the Mag 7. The last couple of weeks have shown both sides of that trade, but we've generally seen a more cyclical tape as we've come through September into October and past the election, and a broader tape that doesn't just invite sort of a flows-driven Mag 7, a portfolio construction. So we like that. When we think about size, though, Ross, what's interesting is small caps, and I even mentioned Bitcoin in the same sentence here, have, as we both know, caught quite a bit. And I think to a certain degree, that is sort of the early digestion of Trump policy on this idea that is anti-inflationary. And we do have, as our colleague Don Rissmiller has highlighted, we do have some building blocks that would suggest inflation is going to remain relatively well anchored as we look out through 2024 and in through 2025, excuse me. And so we don't see much of an inflation problem on the horizon until maybe the early part of 2026. And that's good for small cap shares. The trouble there is that you've got a lot of zombie companies in the mix. 45% of the Russell 2000 is loss making. And so you have to be very, very specific about where you want to put your chips in small caps. So we've maintained a preference for large cap shares. I think there's a lot of opportunity in what I'll call the other 493 away from Mag 7. And so that's where we would be resting our head now as we move into the first quarter.
Yeah, and one of the things I know that you all like to do is in addition to the kind of classic asset allocation framework that you just laid out, large versus small, benched against a 60-40 portfolio, is take your research and say, all right, where are the big structural themes where we can, play in those waters and add value. So as we head into 2025, I do think that focusing on, getting away from the day-to-day noise of the political world and looking at some of those sticky structural themes makes sense. What are one or two of your most high conviction themes heading into 2025?
Yeah, well, I take a half step back and simply say that I think the argument for thematic investing has been bolstered also by the fact that you've had broad performance dispersion within sectors. So if you look within healthcare, you look within financials, you look within with industrials, there's a huge divergence between the winners and the losers. And I think you can even extend that into the large cap, mid cap, small cap arguments as well. So thematics give you sort of the right exposure, we think, to all of the various subsets. When we look thematically, we see four themes that sort of dominate the landscape right now. We would be focused on cash flow aristocrats, artificial intelligence, the industrial power renaissance, and deglobalization. But to just pick on two for a moment, I would be very focused on the industrial power renaissance. The AI trade was really in its first few innings all about bulking up and getting enough power, getting enough capacity to build these large language models in these data centers. And I think industry is finding out that they may not have enough power to meet that demand. And so you have a bipartisan issue which invites a lot of infrastructure investment. And need is immediate. And so the industrial power renaissance, which will be broader than just carbon and broader than just environmentally friendly, is going to invite a lot of different investment towards solution over the next couple of years. So the industrial power renaissance is a theme I think investors want to be paying particular attention to. And then the second is cash flow aristocrats. This is, as we've often discussed, Ross, really companies that can preserve optionality against two, rather important elements of the environment. One, a higher cost of capital, and two, economic volatility. When we look at companies, they really only have 7 things that they can do with their money. There's 3 things three opportunities to return it to investors. That's buybacks, dividends, and the retirement of debt. They have 3 opportunities to invest it back in their franchise. That's capital expenditure, acquisition, and paying labor more or paying more labor. And those 2 things, of course, have different multiplier effects. And the 7th, is they can retain those earnings in the form, they can retain that free cash flow in the form of retained earnings and take all of those decisions another day. So the companies who are generating a lot of cash have a lot of optionality, and I think we'd want to be paying particular attention to those companies that do. They seem to be got one foot ahead of the pack as we look out into 2025.
Yeah, with interest rates higher, more volatile, that makes a lot of sense to me. Well, Nick, thank you so much for the time. Super insightful as always, and look forward to talking to you again soon.
See you again, my friend.